like you said, my name is Eric Milliken. I'm a business attorney. I've been practicing for 11 years now. I started this firm 11 years ago. Now we have 7 attorneys. We work with over 300 companies. We work from kind of inception and incorporation all the way to acquisition. We're outside. We actually just act as outside general counsel, but we'll do the incorporation, investment funding, and then acquisitions. And we have an attorney who could do trademarks, copyrights, that kind of stuff. We work with dozens of venture capital firms as well. So we help them, get started. We help them invest in companies, do due diligence, drafting documentation. Over the life of my career, I've personally worked on about $1.5 billion of investment and acquisitions. So I don't get to keep all that, unfortunately, but it's fun making millionaires. I like doing it. I get a lot of joy out of watching people's dreams come to fruition. I do personally invest in startups. So it's a hard thing to do, but I've had one good exit and then, a bunch of other ones that I think will come in time. I'm an advisor for currently, I think about 8 startups. So basically what I do is I exchange some of my time and expertise for usually a very, very small piece of equity. And currently that hasn't really paid out, but that's okay. I'll just wait it out. And I got, high hopes for some of these companies. Our law firm.
Eric, just quickly, I mean, if
Yes.
you're going to invest in a startup, what would you say is a minimum, like $100,000, something like that?
As low as 10,000.
Really?
Yeah.
They'll take that small of amount. Okay.
Yeah, it depends on the stage of the company. So I'll go through, I have a deck that I have prepared, and I'll go through that, and then it'll be kind of dynamic. You guys can ask questions along the way. And then if we are going too long, somebody will speed us up and tell us, hey, we got to keep on going. So I'll let one of the moderators do that. But our law firm, we don't do litigation. We don't do bankruptcy. We don't do family law. We don't do criminal law. We just do business law. So we're hyper focused on companies and on investments. That's what we do. And as part of that is intellectual property as well. I have a presentation, and before you go and scurry and take notes, I will share this with everybody, and you're free to disseminate it to whoever you want, whether it's a client or what have you. And then as another note, we offer free consultations, and this is a no strings attached consultation. We'll share information, we'll share like templates like NDAs and stuff like that, and we'll share experience. We don't believe in holding back information, and really what we have is experience. And if we give out enough information in a consultation where they don't need us, well, they didn't need us to start. But what usually ends up happening is they'll eventually need us. So we play the long game on this, and it works out. Okay, so I have a shared screen. Can you guys see my presentation?
Not yet.
Okay, let me share it again.
Let me put this. Try it again. There you go.
Is that working?
Yes.
Okay. So there are standard Silicon Valley structures for investing in a startup. And usually that would be a Delaware corporation. Now there's different types of investing. This is kind of more in the techie field and the startup field. And I'm happy to answer questions about other structures, but this is like kind of the Silicon Valley startup structure. So Delaware corporation, 10 million shares. The founders' shares are vesting, meaning they don't get all their shares on day one. They have to work at a company for 4 years before they get all their shares. So as an investor, that kind of locks the founders in for 4 years to work for you to return your investment. Whereas if they got all their money or all their shares on day one, they could quit at any time and they could take a big chunk of equity away. The intellectual property needs to be owned by the company. That's something that is lacking in a lot of companies. And most of the time you want to invest in a company that's already started and launched, because that de-risks a lot of the investment. So these are some of the standard things that investors are looking for out here. And then everybody asks why Delaware, why not just do it in California? The big answer is that you have more shareholder, board, and investor protection. Delaware doesn't let litigators come after your personal property as an investor. They have more comprehensive business laws. Most IPOs come out of Delaware. It's about, I think, 60 or 70% right now. And then they have strongest preferred stock rights. Low state taxes. I'm going to put an asterisk next to that because I've had some really bad issues with Delaware lately. Maybe Curtis can do a separate talk on that one, but maybe I should strike that one. A lot of investors ask, if they should invest in a foreign company, like a foreign startup. So something incorporated in UK or Italy or what have you. It gets kind of complicated. One of the issues behind that is that it's hard to keep an eye on your investment. You're not speaking the same language. You can't look up their company on a easy basis. Legal fees for enforcement can be really hard because you might have to enforce your investment in a foreign country, hiring a foreign attorney in a legal system you don't understand. Unknown investment standards. So, California has a really robust system for investing, and it's been tried and true and proven. Other countries, they do all kinds of things, and not to say it's bad, it's just we just don't understand it and don't know it. So you need local counsel. IP ownership questions, where is the intellectual property domicile, and then just basically fear of the unknown. You just don't know what you don't know when you're investing into another country. So a lot of international companies will come to the US, set up a Delaware corporation, and then transfer their intellectual property into that company just so they can get investment here. Again, stop me if you have any questions. So if any of you or all of you are thinking about investing in companies on your own or as a group, there's something called the Jobs Act that passed in 2012. And this basically allows startups to publish their fundraising on one of these online sites. Here's the 7 top online sites. So you can basically publish that you're fundraising and do it online. There are some very, very strict restrictions on this, but this is an easy way to invest in a company because there's almost no legal fees as far as from the investor. And there's been some due diligence done by the platforms to ensure that the company is at least validly incorporated and in good standing and stuff like that. So these are ways of coming in to invest without having to basically fully commit to being a quote unquote investor and really getting the skills under your hat. One of the benefits to these online portals is that you can take money from an unaccredited investor. So I have a slide on what an accredited versus unaccredited investor is. And there's strict restrictions on that. But basically you can invest, if you're unaccredited, you can invest about 5% of your annual earnings. So these are good ways of kind of dabbling in startup investing. Here's the accredited investor questionnaire. To invest in most companies, you have to be an accredited investor. So these would be for unregistered companies, not publicly traded. So meaning you have to earn 200,000 a year or 300,000 if you're married, or have 1 million in net worth, not including your main home. You can't be a bank or an investment company. Or a charitable, officer director of the selling securities. You can't be a trust, charitable, retirement plan unless you have over 5 million in assets. Or it could be a business owned by accredited investors, such as a venture capital firm. So these are some of the general criteria. If any of you guys are thinking of investing in companies, you have to make sure you're an accredited investor first. And this is more to protect. So the accredited investor criteria is set up to protect investors from fraud, to make sure that they have enough money that they can afford to lose it, essentially. This slide is showing kind of an overview of the terminology surrounding investments. And somebody had asked earlier, what's the minimum investment per person? And it could be as low as $10,000. We usually tell our clients, don't take the investment unless it's around 20, just because we want to make sure the investor's serious, and we also want to make sure that it's going to cover legal fees and all the hassle that's involved with it. So that's one of our criteria. So the round size for what we call a seed or friends and family round usually is about 100,000 to 300,000. So this is for very, very early stage companies. And it's usually used to prepare a company for launch. Like if they have a product, a minimum viable product ready, but they need to hire a salesperson, or they need to pay for some ads or something like that. This is just essentially early stage and for launch. The benefit to investing in companies at this stage is you get a bigger piece of the equity. The drawback is there's a higher chance of the company failing. It is so early on. The next stage would be angel stage of investment, and that's usually 300,000 to 1.5 million. And just to be clear, this is not for each investor, but this is for a group of investors. So you can put in your $10,000 into an angel round, and that's fine. And you're just part of a big group of people doing it. The next segment would be considered a series seed. And that's 1.5 million to 3 million, although these numbers are changing constantly. The landscape is changing and there's a lot of capital available. So it's kind of different. Series A is 1 to 3 million. Series B is 10 to 30, and so on and so forth. So those are kind of the rounds. It's important to know these things. Frank.
Yeah, just clarification. You'd done the slide on the accredited investor.
Mm-hmm.
Is that something that you need for all of these rounds, or is that something you require for the seeds, friends and family, when you only have an idea and you need to borrow from your brother-in-law?
It is required for all the rounds, and unless you're using one of those
crowdsourcing.
What's that? Yeah, crowdsourcing. So it's required, and people get very confused. They think, oh, it's a friends and family round, I can just take money from my friends and family. I'm like, well, yes, but you need rich friends and family. The law does not make any exceptions for this. So you do need it. If you do take money from an unaccredited investor, one, it's illegal, and then two, they can basically call back that money anytime. So we tell our clients, don't take it. It's not worth it. because if they call back that money and you spent it, then you're in trouble. If you call back that money and you have it, but you budgeted it out, and now you have to fire people, you're in trouble. So just play it straight, do it the right way. There's plenty of money out there if you're willing to work for it. So that's a very good question. Thank you, Frank. And I can't see everybody raise their hand. So if you have a question, just unmute yourself and just chime in.
Yeah, so why don't, on your previous slide, what has to happen before you get to the next step? So let's just say you get 300,000 from seed friends and family, and then something happens and then the angels go, okay, I'll put this money in, then something happens and then seed A and B. So can you kind of explain that?
Sure. Let's give a use case that I'm starting a internet social media company. Usually what happens is the founders will sit there and they'll hack it out and they'll program enough to make an MVP, minimal viable product. So they do that, they show it to their friends, they show it to their family, who are all very wealthy and accredited investors. Those people say, okay, we're gonna give you $300,000 to pay for your Facebook ads to help you get traction, to pay for some salespeople to take in money and to do whatever. That money comes in, everything works out. They get 100,000 users during that time. They start making a little bit of money, but their burn rate is pretty high. So they're spending more money than they're earning. They can go back to those same investors and new ones and say, hey, we have this really good product. We have happy users. The lifetime value of those users is $10, but it only costs us $3 to acquire that user. So we have this huge profit margin, but we just need more fuel on the fire. We need to hire more salespeople and do more ads. And so then you get your angel funding. That'll come in. You do that, and then sometimes the series seed is just a skip step, or any of these can be a skip step, and they can go straight for A round, and that can happen. But this is the progression that typically is followed. So once you've proven yourself, you have some traction, you can go to bigger investors and they'll pour more money on. And by the time you get to a series A, you're telling them, okay, we have technology, we have users, we have a proven business model, everything's working really well. We need to hire more engineers, more salespeople. We need a big office building now. Like, we need to really do this right. And the venture capital firms will do full due diligence. They'll look at everything and they'll decide if they're jumping in for that, and writing you a $10 million check. Did I address that, Robert? Or
Yeah, and then I guess the Series A's are bigger risk takers than the Series B, and they're bigger risk takers than Series C, and these guys specialize in just certain series and things. Any idea how much of the company you're going to give? Let's say you have, I don't know, 1,000 shares. Is there something like they give 50 shares to the seed? And do you have any idea about that?
Yeah, the rule of thumb is about 20% per round. So let's say there's 300,000 on that seed round. That would put the valuation of the company at 1.5 million. And so each round that goes by, it's about a 20% dilution of everybody before that. So keep in mind that those seed investors will get diluted by the series or the angel investors, who will then be diluted by the series seed investors, who will then be diluted by the series A investors. And then those will be diluted by the series B investors. So you might start out with, let's say if you put in all the money for that seed round, you said, oh, I have 20%. By the time you get to the series B investors, you might be down to 6% because you've been diluted throughout the process. But on the flip side of that,
It's worth more. Yeah.
Your 300,000 you put into it is now worth $30 million. And you're like, okay, well, I might only have 6% of a company, but it's a big company. So this is some information on angel rounds. It's, from that 0 to 300 million. So there are different ways of investing in companies, and it really it is geographically sensitive. So we're in kind of the Bay Area, Silicon Valley area. There's two different standards of investing small amounts of money, meaning, under $1 million into a company. One is with a convertible note. And this is a debt instrument, and it at some point converts into shares at a later date. There are all kinds of tax benefits to this. Robert, you probably know some of them, and I know Curtis knows about this as well, but it saves the company a lot of money on tax. And so this note will have between 2 and 5% interest. You'll get a discount on the next round of financing. It'll convert at a discounted price. So let's say you put in $1 million with a convertible note, and then the next equity financing comes in and they put in, $10 million. Well, at the very least, you'll get a 30% discount on what they pay. So let's say they're paying $1 a share, your shares will convert at 70 cents a share. So you get a benefit for being an early investor because you were exposed to more risk. And then there's something called a cap, which is the maximum amount your note will convert at. So let's say you put $1 million in on a $5 million valuation cap. So you take 1 million divided by 5 and you got a 20% interest. So for sure you're going to get a 20% interest with a little kicker on that interest that you're on the debt interest you're going to accrue during the term of the note. Does that all make sense? Okay. And I have more slides that kind of go into the equities and stuff like that. So there's something called a SAFE, which is a simple agreement for future equity. It's very similar to a convertible note, but it's not debt. It's a futures contract to buy a futures interest in a company. I like them. They're really nice. They're simple, but most investors prefer the convertible note because the convertible note has interest. It has a timeline to expire where they have to convert it. And it creates a fiduciary duty on the part of the company to honor that debt. Whereas with the SAFE, there's no fiduciary duty. So it's definitely better as far as the investor is concerned to do a convertible note. So Y Combinator, which is an accelerator, is a very famous one out here. They invented this SAFE agreement. Okay. Did I do two? Okay, I think this convertible note one was duplicated. I apologize for that. So the early rounds of funding, which would be angel and series seed, are usually done with those debt instruments, a SAFE and a convertible note. One of the big reasons is it is just so much cheaper for the legal fees. So if you're investing under 2 million, you'd probably end up just doing a convertible note. You're looking at about 30 pages of documentation versus over 300 pages if you wanted to do a equity financing. And you just knowing how much lawyers charge per hour, that there's a lawyer for the investor, there's a lawyer for the company, going back and forth on these things, it can get quite costly to do these equity financings. So we really work hard to push our clients towards the convertible notes just to save them money. And it's also much faster. We can have these things closed out within a couple days versus with the equity financings, it can be, a month, 6 weeks before they actually close. But we're also talking about more money. So when there's more money involved, it's something we have to do, and the companies will just pay for it. It's worth it in the end. So venture capital firms always do the equity financing. And with that, they get special rights, they get special shares, they get preferred stock. Usually they get a board seat. And so it's just a different, it's an upgrade on what happens with the convertible notes, and they get a lot more security. So, okay. When a venture capital firm will invest. So typically what they're looking for is a company with a lot of users or promising revenue. They want a really good team. So they'll really do due diligence on the team and how they're formed. Now, these are all things that any investor should go through to look at, but it is a requirement for those venture capital firms. So they almost never invest in a solo founder. They want you to have a team behind you. And it's the idea is to have kind of a key man, prevent the key man problem. You want a team of people. So if one person leaves or gets hit by a bus, the company goes on. Also, solo founders don't have anybody who has a sounding board. So it's good to have, people to sound things off of and make sure you're not going crazy. And what a venture capital firm is looking for is a minimum of a 10x return on their investment. So statistically, if you invest in a Series A company, you actually have about a 1 in 8 chance that they're actually going to make you money. So their 10x return is just the minimum to get them past the point where they're going to make some money off of the deal. So I mean, that's a huge failure rate. If 8 out of 10 of your companies fail, so they need a big return on investment. Venture capital firms don't really like doing the early stage companies. They want it to be a little further along, meaning that they've launched, they have customers, they have paying customers. Typically, they want to invest in a company once it's making an annual recurring revenue rate of over $3 million. So they could still be losing money, but at least they're generating income. Let's see. And so they get, like I think we talked about this before, they get preferred stock when they invest. And so that gives them protective rights. And here's a little description. And you could probably can't read that here, but if you want this slide, I'll send it to you and you can read a little bit about the preferred stock and what the difference is there. So any company you want to invest in, here is a very, very narrowed down due diligence list, but this is kind of bare minimum of, you want to see the certificate of incorporation, you want to read the bylaws, you want to make sure that the meeting minutes are in order, you want to make sure the founders have stock purchase agreements and all that's done, that all the employees and consultants have agreements in place. This is very important for litigation purposes, but also to transfer intellectual property to the company. These are the employment agreements and consulting agreements will ensure that the intellectual property that are being developed by the individuals is owned by the company. There's a famous example of WeWork, and they were just about to go IPO, and it turned out that the founder registered the trademark WeWork in his own personal name, not the company name. And all these investors missed it, or they let it go. And what ended up happening is he sold it to the company for $100 million right before the failed IPO. So that's a clear example of the investors not doing their job and their lawyers letting things pass. So that's not okay. We'd want to check their intellectual property, patents, trademarks, all that stuff. What are their internal intellectual property policies as far as can somebody take the intellectual property out of the office or how that works? Review their terms of service, privacy policy, vendor agreements, licensing agreements. All these things are important when investing in a company. Now, if you're investing $10,000 into your friend's company, you may not go through in-depth due diligence. You might just say, I trust this person, it's $10,000. It'll cost me, if it costs me $5,000 to $10,000 to hire a lawyer to do full due diligence on this, it's just not worth it. I'm just going to move forward. So you have to do a cost benefit analysis. But if you're investing $10 million in a company, you better bet you're going to go through every single document. And that's that. I'm happy to answer any questions, go back to any slides, and just elaborate on anything or just field anything that wasn't on here.
I'll ask a question again. What you talk about the VC guys looking for 10 times 10-fold return, I guess.
Mm-hmm.
What is their timeline on that? And so when are they looking to get that? And if it is I assume it's a fairly long horizon. How does the inflationary environment we're in now, where your money further down the road is not going to be worth as much? Does that mean it should be 12 times or so? Anyways, just a broad question. What is the timeline on that? And is inflation affecting choices about that?
Good point. It used to be that they thought of like a 3-year horizon on that. And that was kind of like, 10, 15 years ago, that was kind of their thought, 3-4 years. Now it's been pushed out to, 7, 8, 9, 10 years because companies are IPOing later now for bigger amounts of money. And so they want more and more traction. And so what would have previously been accomplished by an IPO of, we're going to raise, $200 million with an IPO. That's being done privately through like a series D or E round where venture capital firms will literally write checks for $200 million to keep a company going. So they're really pushing it out. And so I think it's closer to 8 to 10 years when companies are actually going IPO. To answer your other question on the inflationary thing, this is very recent and it is causing some hesitation with the VC funds. They don't know what to do. So they are not investing as much this year as they were last year. One, interest rates are going up. So there's safer places to put your money. And yeah, they don't know what to do with the interest. And we were doing an acquisition with a client. We were just looking over the term sheet and he brought up a good point. He's like, I'm going to get an earnout of X amount of money over the next 4 years. We're going to pay him for his company over 4 years. We said, in 4 years, this could be devalued by up to 30% if inflation continues at this rate. So what do I have in here that's going to protect me from inflation? And so we ended up going with a different deal where he got stock at a company that was publicly traded. So ideally that stock will be insulated from the inflation eventually.
So Eric, before you started your firm, what was your background in like venture capital, or can you tell us a little bit about your background? Then also, why'd you choose Orinda as a place to set up where that's not quite a Silicon Valley hotspot, or at least not yet, as far as I know?
I did compliance for a mutual fund. So I was basically dealing in securities. And so when I was hanging out my shingle, it just seemed like the right fit because it's something I already knew, it's something I liked. I think it's kind of fun. Orinda was just meant to be a satellite office for us. Our main office was in San Francisco, but when COVID hit, we kept on paying rent, and nobody was going in. We'd go in and check the mail, and that was basically it. And eventually we just our lease was up and we're like, what are we going to do? All of our meetings are over Zoom or the phone. And all of us, all the attorneys are in East Bay. So it's like, well, fine, all right, we just gave up. It doesn't, I don't really matters anymore. It's not, we're not in a hot spot, but our phone works and our internet works, so we're good.
Orinda's a great place. I agree.
And it's a
Yeah,
nice
nice
place.
place.
We don't have to deal with traffic and all, like, it's just, it's made my life better. I will say that. My wife made me open a satellite office, and she was boasting and bragging about that the other day. She's like, look what I did for you. I'm like, yes, you did. Thank you.
Patrick had a question.
If you don't mind, can you kind of go over the safe note and the convertible note one more time?
Yeah, no problem. So do you want me to pull up the slide here? See, is this still being shared or no?
Yeah. I have a question.
Can you guys see this one right now?
No.
Not yet.
No,
Okay, all right, I'll reshare it.
There you go.
Okay, so convertible note. So the convertible note is like a similar to a regular promissory note. See, there we go. It's similar to a regular promissory note, you know, where I'm just gonna loan you money. But it has special triggers in it that say, at the end of the term of the note, it won't be repaid in cash. That note is going to be converted into shares in your company. So it's either at the end of the term, which would be usually 24 months, or if you get another equity round of financing before that 24 months, then it'll convert into shares in the company. There's one more trigger, and that's if the company is purchased within that time. So it's acquired. So if any one of those three criteria happen, you either convert and you get new shares, and you get it at a discount over what the new investors are paying. So you get a better deal. You, if the company is acquired, then you either get your money back plus interest, or you can convert into shares right before the acquisition. So whatever is going to get you more money out of the company. So you get the benefit of either getting your money back or the upside if the company sells for a lot of money. And then if it's at the end of the term and they haven't received any other investment and they haven't been acquired, you can either let the note ride, so it just continually gets interest over that time, or you can choose to convert the note into common stock instead of the preferred stock. So those are the basic terms of a convertible note. It's obviously more complicated than that when you really get into the documentation, but that's the high level overview. And with a SAFE, it's what they call a simple agreement for future equity. So it's a futures agreement. And you can go on most trading platforms and buy futures of any stock on the stock exchange or a commodity, grains or whatever. You can buy these futures that will eventually turn into stock if you exercise the future. So it's similar to that. They modeled it after that. But it also has a lot of the mechanics of the convertible note, but there's no 24-month or general time under the note. So it can convert at any time, or it can convert later. There's no interest on it like with a loan. So the two mechanics you'll usually get in that one is a conversion discount between 5 and 30% of what the next investors come in, or just a cap, whichever gives you the more, the discount or the cap. And the cap would be between, you know, for early stage company, between $3 and $8 million. And so let's say you invest $100,000, or sorry, $300,000 with a $3 million cap. You're pretty much guaranteed a 10% stake in that company. So you can budget and count on how much equity you're going to get. So you know how how your dilution is going to happen when that conversion happens.
Follow-up question. I just did a deal and I don't recall being offered the convertible equity. I do recall, but I'm gonna go back and double check that I only received a safe note agreement.
So these are either or.
Okay, so they don't have to offer the equity, convertible equity. Is that what you're saying?
No, it's either a safe or a convertible note. Those are the two main options.
Okay,
And
Okay.
so the safe is not as good for investors. It's a little
But
bit better for
wha-
the companies, but it's still you're still going to get equity. So that's
right. But my point though, are they supposed to offer both? And you have a choice, or they can just offer what they want to offer?
they offer what they
Meaning-
want to offer. Yeah.
Interesting. Okay.
And
fair.
usually with the advice of legal counsel. So if we're advising a company, which we do all the time, this is what we do, we're going to ask a series of questions. And some of that is, are you raising primarily in California and in the Bay Area? If the answer is yes, we'll tell them, okay, let's use the safe. If the answer is no, we're going to go on the East Coast, we're going to try to raise in Germany and Europe and France, then we tell them you have to use the safe or the convertible notes, because they're just not as widely accepted outside of this area. The safe was invented here, and it just hasn't quite made it around the world yet. And there are companies, like we're working with an African company right now, and they're using safes, but they're also a Y Combinator company, and Y Combinator requires them to use safes, and Y Combinator carries a lot of prestige with it, and so people will do it begrudgingly.
Wonderful. Thanks for the clarification. Thank you.
Yes. Is anybody here an active investor or thinking about it? Oh, Patrick, okay.
Why don't you discuss Y Combinator? Because I know they were involved with DoorDash and what they do, because they got them on the slide, and they ended up making billions when DoorDash went public, I remember. So why don't you describe a little bit about what they are?
Sure. Y Combinator is the gold standard startup accelerator. So they'll take companies in very early, even at just kind of the idea stage. They give them a modest amount of funding, usually about $200,000, which is essentially living money for the founders, so they literally don't starve to death. And then they go through like a boot camp. It's 3 months long, and it's a business boot camp. They help them get incorporated. They help them kind of build their product and their business model. They expose them to customers. They do as much as they possibly can to help a company succeed. And so yes, DoorDash was one of them. Airbnb was another one. Dropbox is another one. I mean, they've what their strategy is they shoot for the moon. Like they go for companies that are disrupting pieces of technology, and that's their main strategy. They most of their investments don't pan out very well, but a few of them have panned out in the tune of billions and billions of dollars. So for their $200,000 investment, they get 8% of your company, subject to dilution in the future. My younger brother, was actually one of the lucky 2% of the applicants that got into Y Combinator with his company. Patrick.
So
Actually, Phil was trying to get through a minute ago. Patrick, I'm sorry.
All right. Do you want Patrick go first? Go ahead.
Oh, either way.
no, Phil, go ahead, please.
Eric, I have a very good friend that I just either got FTC approval or is close. And I'd like to talk to you offline and explain his company a little bit.
Mhm.
And I've already texted him because I'd like you two to get together. And of course, as far as you investing, that would be something in your discussion. You would see how much merit there is or there isn't. But he's an extremely bright guy. And just quickly, he's went to Cal and he developed this program. Apparently, when he was in school, there were all these kids that had these bright ideas. And they had written papers on them and, advanced money to make models and that. But of course, they had no funding
Mhm.
and they had no sense of business at all. So he
Yeah.
developed this company that he wants to specialize with universities and take their developments and raise money for them and bring them to market. Now, whether this is a unique idea or a good idea or a bad idea, I'd just like you to talk to him.
Sure.
And then I'll talk to you a little bit offline.
Yeah, make an introduction. I'll happily talk with them and you, or we can just do a group call together. But yeah, I'll happily do that. And we do, like I said, we do free consultations and we'll give as much information and feedback as applicable.
All
We
right.
don't play hide
He,
and
as I said, he's quite a bit along, but
Mhm.
and I think one round of financing, he did raise 300,000.
seek. Okay.
So he, and he's been encouraging, whether you can afford $100 or $10,000, he's taking your money, so your investment. So anyway, let's see. I know you flashed it on the screen, but do it again. What is your phone number?
Oh, sure. It's at the bottom. You see it now?
Oh, I got it. Okay, I'm ready.
Yeah, and perhaps somebody can circulate this to everybody at the end of it. So we,
Yeah, that'd be great to do that. 341-2888. Okay.
yeah. Todd, would you mind circulating this at the end of it? I can send you a PDF of it.
Yeah, I'd be glad to.
Okay, thank you. Patrick, you had another question as well.
Yes, so if you come out of the Y Combinator, what does that mean? Does that mean your company is probably likely to succeed? Or is it a stamp of approval or success? Or how should one use that?
It's all of the above. It's a stamp of approval. It's a big triumph to get into the program to start. I think their acceptance rate is 2% of the applicants, so worse than Harvard, harder than Harvard. And it is essentially like a due diligence approval on you that you've gone through, and we know you're incorporated, you're set up well, and you graduated, so that's good. But at the end of it, you also get to participate in what's called their demo day. And so they have a big auditorium.
MVP.
Yeah, and each company gets to present each one of the companies will present for usually about 10 minutes and go over what they're doing, their business plan, what have you. And this presentation is in front of most of the Silicon Valley VCs and a lot of angel investors. It's very hard to get in. And so they weed out the press and all that, and they just want investors in there. It's something like 95% of the companies to get through Y Combinator and do the demo day get a full round of funding of 2 million or more.
Thank you so much. Thank you.
And there's a lot of other ones. There's 500 startups. There's Society 3, which is one that I've worked with for years. There's Venture Greenhouse. Like there's a lot of accelerators based on that same model. So they're not the only one. They're just the most prestigious one.
Nice. Thank you.
Mhm.
Michelle,
So
Robert.
Eric, Eric, what are you looking for? What would be, you know, what's a good lead for you? Who are you looking for?
Oh, sure. We represent investors. So if you want to invest in a company and you want us to look over the safe note or the convertible note, we can do that. We can do full due diligence and make sure that the company is in good standing, that they own their intellectual property and stuff like that. We also represent companies, so we do both sides of this, and we can help incorporate them. We can help them file with the Securities and Exchange Commissions, make sure they can fundraise properly. We can file their trademarks and copyrights, different things like that. And Robert, we don't do tax. So
Well, I was gonna say, why don't you join our group? Let's get going.
we don't do tax, so there's no overlap there, and we will
No,
gladly refer them back.
no, I was gonna say, Curtis knows when to refer me stuff, so it's great. Just go to Curtis, and if it's a big tax issue, or something, you know, more complex that I handle, I'd be happy to do it. I did want to mention, probably for the group, and as well as part of your presentation, the small business stock, just quite, it's stock, it's in a C corporation that if you hold for 5 years and you sell it, essentially you do not pay federal income tax on it. Of course, California is going to tax you because they won't go along with this exemption, but it's I think it's the greater of $10 million or 10% of what you put in the company. I got that one right. And you know, I saw you.
1202, yeah, so 1202
Right.
QSBS. Yeah.
Right, QSBS stock. But in any event, it's very, very important for, I would say, early stage investors to get that. You know, I saw using the word vesting. Well, I think you do an 83B election. I saw a slide on that.
Mhm.
And that's just fancy talk to say you get the stock now to get the time running. But if you leave the company, you have to sell your stock back to the company versus saying if you work for 4 years, every year you get a chunk of the stock. No, you own it right away to get that 5-year period running. There was a tax proposal to cut that in half. And say you only get a 50% benefit, but we're done with the tax law. I don't see any changes. Congress has signed off and that survived. So I don't really see a change in that law coming about. So yeah, it's a really important part of the whole process.
I breezed over it because I didn't want people to fall asleep.
Okay, that's my job. They
Yes.
fall asleep.
You and me are excited by it. I've done this presentation or one similar to this probably like 20 times. So at a certain point, I know where I lose my audience.
that's a great presentation. Very good.
Yes, thank you so much.
You're welcome.
Thank
Very
you.
interesting.
Yeah, yeah. Like I said, we're happily do referrals, or if you guys are just thinking about investing, I'll talk you through it. I don't mind. I'm pretty generous with my time. It comes back to me. Curtis knows this too, and yeah, you can vouch for me.
I do.
Okay. I'll just let you know, I'm once I get a copy of your deck, I am going to send it to my son and tell him he should go talk to you because he's really kind of at the beginning of investing, you know, at the very early stages. As I say, a lot of his buddies at DoorDash have, you know, taken their money and started companies and all that. So he's still there, but yeah.
It won't be that long.
Yeah, no, it won't be.
And for those early stage companies, we have a lot of flat fee packages, like setting up the corporation and filing your trademarks and, you know, getting convertible note funding. These are really, they're startup affordable. And we do that on purpose. And, you know, we make a little bit off of them, but not that much, but it's really a long-term investment by us. So in other words, we make it affordable, whereas the big law firms try to get every ounce of juice out of you as they can. So we'll happily talk to them and set them up.
Great. Thank you, Eric. It was really, like I said, a very interesting presentation, and I think you saw some decent engagement from a number of us.